The European Central Bank's (ECB) Governing Council on Thursday, 6 March 2025 decided to lower the three key ECB interest rates by 25 basis points. Accordingly, the interest rates on the deposit facility, the main refinancing operations and the marginal lending facility will be decreased to 2.50%, 2.65% and 2.90% respectively, with effect from 12 March 2025. According to them, most measures of underlying inflation suggest that inflation will settle around the Governing Council's 2% medium-term target on a sustained basis. Domestic inflation in the euro area remains high, mostly because wages and prices in certain sectors are still adjusting to the past inflation surge with a substantial delay. But wage growth is moderating as expected, with profits partially buffering the impact on inflation. ECB staff now see headline inflation averaging 2.3% in 2025, 1.9% in 2026 and 2.0% in 2027. The upward revision in headline inflation for 2025 reflects stronger energy price dynamics. In particular, the Governing Council's interest rate decisions will be based on its assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation and the strength of monetary policy transmission. The Governing Council was clear that it was not pre-committing to a particular rate path. The ECB is the central bank responsible for the monetary policy of the 19 countries that are European Union (EU) members which have adopted the euro as their legal tender. It directly supervises the 114 significant banks of the participants' countries holding 82% of banking assets in these countries. The ECB's primary objective is price stability. The Eurozone holds significant economic importance for Kenya as it is Kenya's largest export market, with the majority of Kenyan exports to the EU consisting of agricultural products like tea, coffee and cut flowers, creating a major source of revenue and employment for the Kenyan economy. These latest interest rate cuts are likely to make new borrowing less expensive for firms and households and increase loan growth. This will also lead to a surge in Kenya's exports to the European Union, which is a boost to Kenya's gross domestic product. This report has been brought to you by Yako Eco, from Kenya. Follow us for finance and investment updates.